How's it going, you guys? This has been a crazy week for GameStop, and we are hovering right now at $117 of GameStop. That's up 7% on the day, which means GameStop has been green in an entire sea of red for a long time. Professor Meatball knows this. Andrew, the data scientist, knows this. Hello, if you guys are just joining this show, I really do appreciate you guys showing up, coming out, and helping us learn a little bit more about what GameStop is all about. I have a big data dump for you guys, and if you guys are confused or need an update, this is exactly the comprehensive update you are looking for. A couple of questions I'm going to cover in this comprehensive analysis include one, why did everyone say GameStop needed to get to $800 today in the Thursday and Friday run up to the gamma squeeze? And then two, why exactly did GameStop decide to dip? And three, what is going on with the future of GameStop, and can it turn into a crypto game according to Jim Cramer? Well, let's cover all of that in this video. Make sure to watch all the way to the end. Make sure to give that subscribe button a little tickle if you haven't quite yet, and try and smash that like button as well. So with that out of the way, let's look over here at a couple of the DDs that I wanted to cover. First of all, I wanted to cover the overlaid charts of the daily short volume on GME back right here in February, and the daily short volume on GME in January. As you can see, we are looking at a couple of different variables at the same time, but right now the bar charts are the short volume in blue and the total volume in orange, and this gives us the calculated gray lines, which is the percent of float, and the yellow lines, which is the percent of total. As of right now, we can see the differences between January and February, and it is looking good. If we notice here, January 21st and the 22nd have very similar up trends as the February 24th and February 25th. As of right now, it's important to note that GME is currently in 58 million shares are shorted. That's 107% of float and 84% of total. Now, all of this content in this video is researched, but by people who are doing their own research, which is what I always recommend. Make sure to do your own research. Make sure to understand that this content is not financial advice, and with that, we are going to continue onwards. Now, we have an entire comprehensive DD of exactly what happened with the price of the stock dipping almost below $100 yesterday, and that's why we want to be able to give this post as much love and attention as it needs. Now, Hey, it's Pixel user on GME has been working on this DD for a couple of days. So let's start with 9:35 a.m. yesterday, Thursday. The market opened and we had a huge drop off in price and huge spike in volume. Hedge funds shorted over 18 million shares over the first 5 minutes. The amount of shorting was so aggressive that trading got halted twice within 5 minutes. Within the first few minutes, 9:45 a.m. to 1:50, trading pretty much went in our favor this time around. People kept buying in. Thank you for the super, Ryan. We hit the daily high at about 185 at around 1 p.m. and went sideways for almost an hour after that. 155, poop gets interesting. Really aggressive shorting for the second time that day brings the price down to $126. At that point in time, between 5 million and 7 million shares were shorted in the blink of an eye. What stood out for me at that point in time was that the price kept going in the same direction after every short attack between $100 and $125. That tells me it was really important to get the price down in that direction. More in a few seconds. 2 p.m. to 3:25 p.m. People buying in again, driving the price up to $140 to $150. Now, poop gets interesting. 3:30 to 4 p.m. The third aggressive short attack begins and keeps on going for 30 minutes until the market closes. 10 million shares were shorted in this time span. Now, the analysis. Where did they get so many shares to short GME, and why was it not predictable? Well, how could no one foresee this? It's simple. Hedge funds didn't borrow shares to short. They created them out of thin air. When the market opened yesterday, all available GME shares to borrow were already gone. And at their 10 a.m. today, 0 shares available for GME right now as well. So they borrowed over 2.1 million shares to short for yesterday and today. What does that mean? Well, no one can predict or analyze how deep they are digging their own grave right now because they are not using real shares to short GME. They can just keep doing this in order to hold the price down artificially. And I've explained this before, but I will explain it now. How does shorting decrease the price of GME? Well, when you take a stock and borrow it from someone and then sell it immediately, you have just borrowed a sale from the future. You see, the stock still belongs to the person you borrowed it from, and yet you've already been able to sell it? How is that possible? You've borrowed that sell from the future. Now, as the market notices that sell, it is going to take it into consideration. More sales mean that the price gets lower, and the more buys mean that the price gets higher. So now that you've borrowed the sell from the future, you have in the short term decrease the price of the stock. If enough people do this, which is what hedge funds are hoping for, it might bankrupt the stock before the long-term effects, which is eventually you are obligated to buy. And that obligation means that in the future, there could be recursive buys of covering these shorts that have essentially, like the analogy says, dug their own graves. So what happens when we add up the shorts and the price dips mentioned above. Now it just gets stupidly funny and obvious. If we add up the three big short attacks, 18 million right at opening, 5 million to 7 million at noon, and about 10 million right before close, we get 33 million shares sold short over the day. Why is this funny and obvious? Well, check the latest FINRA report. It states that yesterday more than 33 million were sold short. That's almost exactly the number that we get when we add up the volume of the dips. So why did they cross the GME so aggressively with fake shares? Because the bears are vogue. See, when GME would have closed in between $115 and $150, over 44,000 call options would have become ITM in the money. So if exercised, that would drive up the price after hours in pre, or today in high hundreds, maybe even thousands. So why is that so bad? The higher the price gets, the more calls get exercised, so called options chain, and the more people jump in because the FOMO as we get closer to the magical $800 mark, where the mother of all short squeezes would become inevitable this or next week. What can we learn from this moving forward? Hedgies don't give a single F anymore, even when all the data available states that there are no more shorts available to borrow for GME. We found all of their ETFs where they hid their shorts. They keep shorting it to try and stop the mother of all short squeezes. You know what they say, there is nothing more dangerous than an animal that's trapped in a corner and got nothing to lose anymore. That's what we're seeing right now. No one can give accurate predictions anymore. That is based on data. This has evolved into a game of pure greed, and emotions. They don't care about the long-term results of their illegal actions. They just want to save their butts for some weeks or even just days. In short, be prepared for everything. Don't be scared of dips. They are more likely created artificially by highly illegal shorting with faked shares. Now, this is the point that I have to be very clear. This channel is not for giving financial advice, and this Sherlock ape might not be correct. They weren't correct yesterday with their predicted price share of $200 to $220, and they may not be correct about this either. So do your own research. Make sure to become financially invested in yourself, and one of the first ways you can start investing in yourself is smashing that subscribe button and making sure that the bell button is smashed as well, so you don't miss out on live streams where I talk about this live with you. So back to it. Too long didn't read. Hedgies are so effed that they just shorted GME with more than 33 million non-existent shares yesterday, keeping the price down in order to stop the gamma squeeze from happening. Now, the gamma squeeze is slightly different than the short squeeze that we've talked about, but the short squeeze is in that situation where we borrowed shares in order to give them back in the future. If I did that multiple times over and over, I would have to recursively cover those shares, and that would be incredibly inflationatory. It would inflate the price higher and higher unto an infinite squeeze if everyone holds. But a gamma squeeze is based on call options. Now, call options is a right, a privilege, but not an obligation to buy a stock at a future price. You buy it at a premium, and then you say when you are in the money, you get to exercise it as long as the deadline, which a lot of these call options have deadlines today. We are trying to catch these call options so that most of them become in the money, so that we have all of these buys from the institutions needing to exercise the call options that other people have already bought, increasing the price in the aftermath. So the price would have jumped to a few hundred, maybe a few $1,000s today. This is just hypothetical. If they didn't do it, which would have started the real squeeze today, they have nothing to lose anymore, so be prepared for more highly illegal action and don't get scared by fake dips. In short, they like the stock. So we also have a couple of edits from them. Edit number 1, according to this site, the short sale volume was 61% yesterday with a short sale volume of 50 million. That doesn't mean that hedgies opened 51 million new short positions and being really conservative and sticking to the 33 million. If it's even more than that, even better. So we have right here this price, the short volume percent, really hovering up there. But at the end of the day, that is a ton of short volume versus the long volume. Edit number 2, to all people wanting to understand naked shorting, here is a great read. And if you still don't really understand how these counterfeit shares could happen, let us give us a quick overview of them. Naked short is an invention of the securities industry that is a license to create counterfeit shares. In the context of this document, a share created has the effect of increasing the number of shares that are in the marketplace beyond the number issued by the company. It is considered counterfeit. So this is not a legal conclusion, since some shares we consider counterfeit are legal based on today's rules. The alleged justification for naked shorting is to ensure an orderly and smooth market, and all too often it is used to create a virtually unlimited supply of counterfeit shares, which leads to a widespread stock manipulation, the linchpin of this massive fraud. Returning to our example, everything is the same except the part about borrowing the share from someone else's account. There is no borrowed share. Instead, a new one is created by either the broker-dealer or the DTC without a borrowed share behind the short sale. A naked short is really a counterfeit share. Edit number 3, 930, the fee to borrow GME went up by 12% overnight and is therefore in the double digits for the first time since 4 weeks. This is really huge. Edit number 4, how do I know that hedgies are not retail selling their shares? It is possible that some retail traders sold. In fact, a couple of you in the live chat were one of them. Congratulations. But if you take a look at the short volume, 61% yesterday with 51 million shares being sold short, then take a look at overall sell volume. It doesn't add up. If there was a huge retail sell-off, an additional 61% short volume, the price drop would have been much bigger. Most retail held through, therefore they had to aggressively keep shorting because no one was selling. That is you in the description, in the comments, telling us exactly what you are planning to do, and not taking any of this as financial advice, of course. And number 5, they're preparing their next DD right now, and oh my god, yesterday's actions fit right into the pieces, and they can give a date for the squeeze to take place, almost certain, but they don't want to make false promises, so take it with a grain of salt, because lots of different pieces fit together for that exact date. If they're able to finish it today, they'll link it here as well. This actually feels like a conspiracy theory because everything happening right now points to that specific date, making it feel too easy to be true. Oftentimes, when things feel like they're conspiracies, they really might be. So if you guys follow this live stream, I am going to continue working to make sure that you guys are updated with that person's DD. But of course, one of the most important pieces of this puzzle is the gamma squeeze, and we covered it briefly, but we want to understand, why is the option betting on the stock reaching $800 on Friday? Well, I'm just going to zoom through this Bloomberg article because the main point right here is this paragraph here. For other options traders, it was a question of when GameStop would hit the $800 mark, not if. The 7th and 8th most active contracts were call options wagering that the stock would reach $800 by next Friday or in 3 weeks. It's hard to say whether the contracts were mainly bought or sold, two traders said. So now that people are betting very much in the $800 range, a lot of contracts would be in the money, which would cause a lot of buying action if they were filled today. Finally, I want to cover this seemingly wacko theory by Kramer that says GameStop can justify its valuation by turning into a 5,000 store introduction to crypto. This is just a simple, I would say, clickbait article title. Kramer says that if the GameStop turns itself into a crypto information space, the worldwide games with no latency would add to the credibility of GameStop investor and Chewy Inc. co-founder Ryan Cohen. They think that he thinks that this is one of the only ways to make GameStop worth its salt in the current market. So what do you guys think? Is GameStop worthwhile to you? Do you like the stock? Do you feel like it is just days away, weeks away, or months away for the short squeeze to happen? The gamma squeeze might not happen today, but it does not mean that today was a missed opportunity. Call options are constantly going to have deadlines that are rolling. In fact, even that article on Bloomberg said that there's still some call options expiring in 3 weeks. So if you understand a little bit more about GameStop, I would really appreciate a smash of the like button, a hit of the subscribe button, and check out a couple of the links down below, especially the technical app that I use to look at GameStop is Webull, and you can easily get 2 free stocks if you use the description down below and start getting out of Robinhood. In my opinion, you are doing great. Continue being you, and for now, but not for forever, hope you guys have a nice weekend.